Middle of this wick here, that is 3982.50. This one here is essentially the same thing that's been shown or outlined for this wick. You're getting the middle of that wick measured here. So that's also a level you'll see when we go into lower time frames. This candle's high is the exact to the tick low of Wednesday's trading. That's perfect, folks. There's no room for improvement. So we also had this candle's low, which is 39.61 and I think 3/4, something to that effect. But you'll see it also when you get in the lower time frames. All right, so here's the hourly chart, and that same fair value gap on the daily chart is being shown here. And the fair value gap is the PD array, and the classification for the fair value gap is a BISI, meaning buy side imbalance, sell side inefficiency. So it was delivered on the daily chart with an up candle, and it would be expected to see the algorithm deliver to the downside with sell side. So here's the opening price at midnight here, New York local time. So ideally, if you're trying to trade the daily range, if you're trying to get in there and trade like my algorithm would seek to trade, which is if I'm going to be bearish and selling short, I want to be entering short above the opening price at midnight. Preferably, that's what I'm looking for, because I'm entering in an area where smart money is accumulating the largest portion of their short position for the daily range. I can also utilize the 8:30 opening price, and I can use the 9:30 opening price. So there's 3 opening prices that I like to use within the 24-hour trading period. All 3 of them can be utilized uniquely and independent of themselves. But the largest portion of the day can many times form overnight in London, unless we are in consolidations like we have here, where we can see from yesterday morning, we have just been chopping around in this big range. You can see how we drifted down into 39.82.5 and 39.73 even, which is the daily candle that has both those wicks on the low end of the candle. Split those wicks in half, measure them 50%. You'll get this level and this level, okay? Dropping into a 5-minute chart, here's a 9:30 opening bell. We wait for that. And we had a lot of choppiness in here, back and forth, and I'm looking for Tuesday's high to be taken out. And we had this buy side liquidity pull form here, and then it finally punched through it, created this short-term low here, but notice it didn't take out this low yet. Now, you could argue and say, what about this one here? I wanted this one to break down more specifically because that was the one that ran from there up into the new higher high and took out this spike over here. So that run here, I wanted to see that one taken out. I was aware of this short-term low, but I was not trying to commit to that because I felt because we were in a larger consolidation, it still might spike up in there and run 40.36 because it failed to do so on this high here. So if it would have spiked above Tuesday's high, then I would have used this low here as a shift in market structure bearish. So when it did this move here, this is what I'm talking about when things are algorithmic. Algorithmic theory relies a whole lot on if this occurs, then that. If this occurs, but not this, then that. So there's a lot of if-then syntax. Everything has to be weighed on decisions that are binary. This low was not taken out until here. Now, I knew before this low was taken out here that I wanted to go short, but I did not want to take that short-term low here when it broke down here because I felt that this could have been just one more time where it was leading people astray like myself or anyone else that would trust that that high was formed just on that shallow little run with this move here because it did not take out Tuesday's high, previous day's trading high. If it would have done that, then this short-term low was broken. Then anything in that high at 40.36 to this low, taking out that low, if there's a fair value gap in there, I would trade that and I would be content with that, riding it down to 39.82.5. But I did not trust this high. I was looking for that 40.36 run, maybe spiking into 40.40. So this run here below the short-term low, in perfect hindsight, it looks great. But I can tell you the logic I was waiting on was that spike higher above Tuesday's high because we didn't get it. It is what it is. So let's go into a 1-minute chart for the morning session. All right, so here is that low I mentioned on the 5-minute chart. If we would have spiked up to 40.36 and took out Tuesday's high, then break down like it did here and took out that short-term low, then I would have trusted this as a shift in market structure, even though on the 1-minute chart we have a gap. But because this could have very easily ran up and hit that Tuesday high, then I would have had to use the same protocol of using whatever swing low formed from this low up to that higher high at 40.36, which didn't occur, but had it done it here, and I was making allowance for that, it wasn't until we broke below this short-term low there But we broke down, we had a nice little fair value gap in here ahead of the sell side liquidity being tagged, which it does, runs up, fair value gap, and bearish order block. It drops down. Now notice that this signal and this signal here forms very close, in close proximity to the midnight opening price. That's what this little purple dotted line is. So there is two setups that were beautiful if you want to get in alignment with a large range day using PO3 Concept that I teach. And it moves lower. Then we have the order block, which is the last up close candle prior to this displacement coupled with a fair value gap. Mean threshold trades up into it here, breaks down, attacks sell side below here, expands lower, institutional order flow entry drill, multiple ones here. It's a high frequency trading entry technique where it just goes into and touches the candle that would create a fair value gap or imbalance. All it has to do is touch that like it does here and here. And high frequency algorithms are going into the marketplace right there. Sometimes it just goes up one tick, but that's usually what they're using, the entry there. So it breaks lower, sell side imbalance, buy side inefficiency, which is a fair value gap, but the classification is SIBI, S-I-B-I. Runs up, reprices to it here, leaves it again, bounce price range here. It's not going to go back up into it again. Smash, and drifts into the lunch hour starting. I'm going to take you into the very moment on the 1 minute chart, and you can see how this was a mess. It was just, this is an entry technique with the fair value gap there. This was a technique here with this fair value gap. I went in here, and when we ran above the buy side, you saw me take a partial there, and it came all the way back down and stopped me on the bounce. This was another one here. I was working with my son, rallied up, and then I was looking for 40.36, and then it come back and stopped me out over here. No fair value gap in here. So even though we have a short-term low here, any one of these could have been misinterpreted. Not saying this one here could have been misinterpreted today and utilized as, well, this is the shift in market structure. And because it was multiple ones here, the fact that any one of these were taken out to the downside with price delivery here without the Tuesday high being taken out, which is what I was making allowance for in my expectations in the morning session, post 9:30, I wanted to see that run up there. And I didn't want to get caught offside in the event that they were going to do another run up and clear it out. So because of this shift here and then returning back up into it and me thinking it was going to likely go up to Tuesday's high, I did not trust any of this until we had that short-term low right there taken out there. The reason why I felt this candle when it was trading up to here, now why would I trust something like that even though it went through it? Look close. This is institutional order flow. Listen, folks. When this low was taken out, that was when I liked price, because this candle had already ran up and hit the bottom end of these up close candles, that series of candles. This is my bearish order block. Look at the opening price there. It's perfect to the tick. So this opening price runs up to it, hits it perfectly and delivers lower prices. The next candle here creates that fair value gap. And then this candle here, I see it run up into that. And that's when I'm saying, okay, this is where I would be short right as it's doing that. As it runs up and hits the bottom of this candle here at the opening price, then it's trading lower. The next candle trades up. Next candle trades right back up into this candle's opening. Series of 3 up close candles. Opening price, that's my order block, stops it right there, dead in its tracks to the tick. You cannot improve on perfection. When I see this type of signature where it runs up here, I'm expecting it to do immediate repricing lower. Well, the next candle opens down here, runs up, half of the wick, that's consequent encroachment, mean threshold of the up close candle here, perfect delivery, start looking for it to go lower. Here's the afternoon showing the 1:30 to 4:15 time window. Last hour of trading, we'll look at that in a moment. Fair value gap in here, we trade up into it here. We break down, return back to the fair value gap, create another smaller fair value gap. This is a short, that's a short. Sell side below here, rips into it here. If you take this high to that low, expand that lower as a measured move, multiply that, then project it lower equally, and you'll get the range lows that we're seeing here. At the last portion of the day at 1:30, if you're bearish, you can use the opening price at 1:30. Treat that the same way I teach you to use it on the midnight candle in New York, and at 8:30 and at 9:30. If you're bearish, the market rallies above that opening price, goes into a premium array, as we see here, you can expect this to do what? Sell off and treat this whole price movement the same way I teach Power 3 for a daily chart. You can treat the same idea of Power 3 within a session. So everything is fractal. The algorithm sees it just like this. Opening price, this is a Judas swing. It's all manipulation. Up into a premium, trades lower, rallies back to the short-term premium array, trades lower, fair value gap, trades up until here. This low being taken out here, this is model 2022 right here. Now think, I teach you to trade this at the 9:30 opening, right? Everything is the same. We're just applying it to the market in small little segments the same way my algorithm does. So the logic the algorithm's using is it's using the protraction from this opening price when it's bearish and it still has undelivered targets down here. It's running up, trades down, one more time up into a fair value gap, and then because of that, it creates that short-term low. It breaks below that short-term low, fair value gap, your eye goes right there, from this high down to that low, midpoint equilibrium, so you're looking for a fair value gap at or above equilibrium. Where's it at? There. Trades up into here perfectly, breaks down, here's a wick, where's it trading up to? Midpoint, right there, there's another sell. So you can sell here, pyramid, wait for sell side to be broken there. We're partial, which is the top of the fair value gap on the daily chart. Trades down into midpoint, consequent encroachment, that's a partial. And then as it hits here, you don't want to use the low of a fair value gap for your target or partials. You always want to come off of that a little bit. Anywhere between a half a point to a full point, you'll always see me try to do that at the very minimum. There's no need for that. And the 1 minute chart in the afternoon session, here's that fair value gap from the 5 minute chart inside the New York lunch hour. Extended it out in time. We trade up into it here. We shift lower. Fair value gap trades back up into it here. We break down. Remember I said once that low was taken out in the afternoon, after it ran up here, once that low is taken out, which it does here, that's a shift in market structure below the 5 minute low. We're seeing it on these individual 1 minute candles. Your eye goes back to what? The 5 minute fair value gap, which is this rectangle here. It's anchored to this right there. These two lows here on the 5 minute chart are those single lows on the 1 minute chart. And this run right here is back into the 5 minute fair value gap. Refer to these 2 points here, these two lows and this high. That's these two equal lows on the 5 minute chart. When price goes below that, that's a shift in market structure. And then returning back up into that fair value gap, which this rectangle represents, that's that return into the 5 minute fair value gap. That's sell right there. And then here's that run back up into the middle of the wick on the 5 minute chart. And then it breaks down, creates a fair value gap here. Here's another partial. When this occurs here with this fair value gap and it trades up into it here, what time of day is it? It's during the final hour of trading between 3 p.m. and 4:15. So this run here, opening price, extending out in time. This is a Judas swing, trades up into a fair value gap, breaks down. Fair value gap, trades up into it. Last hour of the day, displacement at a old daily low. There's lots of liquidity that comes in around daily highs and lows. So one of the best things you can do is use your daily chart and use daily highs and lows over the last 3 days. So count today as day 1. You have the highest high and the lowest low of that total range. You have the individual highs and the individual lows. That is a dynamic matrix of liquidity that you will never exhaust for future trade setups because it's just brilliant. You can see them forming all the time. And this is what it kind of looks like right in here. This is a model. This is a specific PD array aligned with an old daily low while bearish. Time of day, last hour trading. So the market runs up, sells off aggressively. Look at the bodies of the candle respecting the fair value gap high. Folks, that's algorithmic. Then it drifts. The high of this candle is the exact high of the fair value gap. It breaks, fair value gap, trades down, midpoint of the fair value gap high and low, consequent encroachment. It reacts to that, back up to what? The fair value gap. Stops midpoint of that, consequent encroachment. Trades lower, comes right back up. Where does it stop? At the bottom of the fair value gap, which is this candle's high. Perfectly. It stops in the midpoint, it stops at the low point. And once it leaves this fair value gap, where does it go? Right down to the fair value gap low, to the tick, and stops.